Eastern. One of my next guests says that we can't expect a big rise in middle-skilled jobs on the way. I'm joined by Fairfax Global CEO Paul Dietrich and by Merck Investments President and Chief Investment Officer Axel Merck. Good to have you on the program. Thank you so much for joining us. Do the jobs numbers matter to the markets tomorrow, Axel?
I think they matter in the sense that it's a great reason for the market to sell off. If the numbers are good, it means the Fed is going to proceed with an exit. If we proceed with an exit, interest rates will rise. The headwinds caused by that are going to be tremendous because central banks have been compressing risk, meaning things are not risky anymore because of the Fed's actions. Well, if the Fed has an exit, things will appear risky again. Volatility is going to go up. Asset prices are going to come down. And so good news is bad news. But bad news also is bad news, as we saw with the PMI numbers
So
yesterday.
You're expecting a sell-off?
Yes.
What do you think, Paul?
Well, I think the real story here, and it is long-term good news, is that we're seeing a rotation in the type of jobs as well as everything going up. When you come out of a recovery, you largely see the lower service jobs, the minimum wage jobs. Now we're moving into these middle-skilled jobs that are at least $13 an hour. They do pay a living wage. Some of them go up to $70,000. In the next 2 years, 40% of all job growth in America will be these middle-skilled jobs. You don't need a college degree for them, but you need some computer skills. You need something more than a high school education. And these are the jobs that are coming back. Manufacturing, work in the engineering industry, the healthcare industry. These are good jobs. And I think this is the story. People have been upset over the jobs they've been getting because the lower-paying jobs just didn't do it when they lost their higher-paying jobs. Now we're going to see these better jobs, and I think this is good for America, and it's good for the rotation.
They're jobs that are actually paying a good rate, and they require some kind of training in order to get those jobs. So that is certainly good news. But I guess, Axel, your point is that good news is good, but it's also bad news for the markets.
It's bad news for the market. I mean, playing into this, it means inflationary pressures will rise. We've talked many times about how the labor participation rate is so low. Well, the reason it is so low is because people are turning 65, they get Medicare, they are on disability insurance. So the incentive to go into the workforce, as we need these workers, is very, very low, which means we are close to full employment, as dire as the situation is, which means that as we progress, and as Yellen is reluctant to raise rates, suddenly the market is going to perceive the glass to be half empty. As we look out to 2015, what do we do with this so-called good news?
You know, I feel like the markets or investors would like to see some kind of a flushing out. I mean, yesterday we had a good sell-off, 200-plus points on the downside for the Dow. A similar situation happening the week before. But every time we see this kinds of selling, it is met by buyers, buy on the dip. Was it enough? How significant a sell-off are you expecting?
A much more severe one, because at this stage, we've been lured into rising equity market and low volatility. People are not aware of the risks in the market. Things have to plunge. And the problem we have is there are no short sellers there. And the reason that's a problem is because short sellers act as a buffer as they cover their shorts. So I think a market crash is quite possible in this sort of environment.
Market crash being what? Are you talking about 10%? What are you talking about?
That's not a crash. I think a 10% correction is the very least we should expect. I think something much more severe could also be in the cards.
Like what?
Well, 25% I think is easily possible.
Over what time frame?
These things can happen. I mean, we've had flash crashes. These things can happen in a very short time. We've been primed that equities go up and up and up. Over the last 15 years, equity markets have gone up about 5% a year. In the last 3 years, 15%. That's not sustainable. But everybody buying the market thinks equities will go up forever these days. And that has to change. The perception will only change if we have a very severe correction.
I guess I want to ask you, after I get to Paul in a second, I want to ask you how you prepare for that. So if we're going to see a 25% sell-off in stocks, what do I do with my money that's in the market right now? So hold that thought and think about it. Paul, let me ask you your take on what implications that brings if we were to have a big sell-off like what Axel's talking about.
I disagree. I think, the underlying economy in the U.S. Is really good. We're seeing slowing in Europe, if not a recession, and the same thing in Asia. And that is going to affect profits, and earnings do affect the markets. 52% of the S&P and the Dow earnings come from outside of the United States, so I do see a slowing. We are clearly overvalued. I think we're going to have a 10 to 15% correction, which would be it would bring us back to fair market value. I don't think that this is bad. I don't think we should be upset about this.
When you talk about fair market value, I mean, the valuations, I know there are certain pockets of the market that are, excessive. When you look at some areas of, social networking, and obviously when the biotechs were on fire earlier this year. But when you look at the average S&P 500 company, it's not an excessive PE. It's trading at what, 16 times earnings, 17 tops?
Yeah, but
not even. It's 15.
You looked at Robert Shiller, who's the Yale economist and Nobel Prize winner. He did an article last month for the New York Times. He thinks everything is overvalued on his methodology of doing it.
It's not about valuation, though. It's about complacency. It's the low volatility. When volatility spikes, people have to reassess what they do. It doesn't matter what the earnings are. It's about the perception: is the glass half full or half empty?
Well, that's a different conversation.
And rising, and the Fed pursuing an exit forces volatility up, and that has to reprice assets. Now, what to do about it? To extend your equities, buy protection, try put options. But more importantly, the time to rebalance is during the good times. Take some chips off the table. The question is where to put it to, because I don't like bonds either. We like currencies because that's what we do. We like gold because that's historically been a good diversifier. In short, though, there is no place to hide because asset prices in general are elevated.
All right, so the dollar has been soaring. Does that continue? Do I move some money into currencies?
There's a lot of good news in the dollar that's priced in. The important thing about currencies is you can create uncorrelated returns. You can go long the Australian dollar, short the New Zealand dollar. That will generate returns that are not correlated with the markets. That's what you're looking for. You want to be at something that doesn't move in tandem with the markets.
All right, gentlemen, I mean, thanks for the good news. I don't know. Gentlemen, thank you very much. Axel Merck, Paul Dietrich, good to have you on the program. We so appreciate your time today. We will be watching these markets. Axel, thanks for the heads up.